Hey everybody, Steve Ankerstar here, and welcome to the Ankerstar Wealth morning/afternoon update. It's been a long week. Some of you had asked, "Hey, where's the morning update this week?" This week we were swamped with an internal project that we had going on, in addition to the challenges of the market, which meant the phone was pretty much ringing off the hook all week. So I'm not complaining about that. That is exactly why we're here. So please continue to reach out. Just realize that sometimes, if something's I'd rather answer client questions directly than make a video sort of thing. I tried to get out in front of that this week. I got behind and there was no catching up. But it's Friday afternoon. I think we're caught up now, so we should be good to go for the morning updates next week. But I wanted to give you kind of one big update recap, if you will, for the week. And all we're going to talk about is where the market is and where it's going and what is driving it and what to do. Right. So, but before we begin, as a reminder, the financial education presentation should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Now let's get started talking about this market. Down close to 5% this week, down for the last 5 weeks. So really, we need to really look at where we are. And I use the NASDAQ because I'm more tech heavy, and the NASDAQ's been hit harder than the SPY for sure. But here's where we are. We are in a 1-year chart. We're on the NASDAQ. So here is the peak last year, November, December. Pretty well good sell-off to March. We had the bump here for a little bit around the end of March, sank to our lows of the year, which were mid-June, and then we had this move up, and then we're sinking back down, right? So here's that last 4 or 5 weeks, except for that one blip. And we'll talk more about what's driving it here in a minute. But the question becomes is, well, there's negativity in the air at an exponential level. It's hard to find anything positive. It's hard to find anybody saying, you know what, it actually is just going to be fine. This is normal bear market reaction, but it really is. So now, as a mental exercise, if you will, it's not often where you are, it's the journey of that took you there, that gives you your mental framework. So what I mean by that is obviously this is the reality path. And why does it seem so bad? Because we bounced so hard from mid-June to mid-August that now it seems like the world is ending because we thought everything was good again here. Now, for a mental exercise, if you will, take a line from June 15th and draw it over here to where we are today on the 16th of September. If the market was a straight line there, we would be celebrating where we are today, just because we are off the bottom of the year. If it had been a straight line from here, just walking its way up, don't follow the yellow dot, follow the plus there, all the way to here, we would be celebrating. We're at the same place. So all it is the path that we got here. This path is particularly brutal because it gave us this false hope, the bear market bounce, if you will, and then right back down. So what brought us down here? First of all, it's all about the Fed and what they're going to do with the interest rates. Chairman Powell a couple of weeks ago now said that the more pain ahead, meaning instead of being past peak inflation and reducing the size of the rate hike, we're still going to have a rate hike, but reducing the size of it from 75 basis points to 50, that was what caused the optimism. And then, of course, as soon as he said more pain ahead, everybody's like, well, I guess we're not out of the woods yet. And in fact, that is the case. So we have the Fed on one side, and then, of course, we have companies out there that are reporting earnings. And across the board, earnings have actually been pretty good. But when you have Intel, laid a bomb the other day, FedEx just dropped one to this morning, he expects this is one person's opinion, and I would say, equal to everybody else who's got one. But the fact that he's sitting in the chair of FedEx and he wants to personally crush his stock by 20-some% by talking about how he expects the economy in a worldwide recession, that's a pretty aggressive take. What the CEO is supposed to be reporting are the numbers, right? So they missed their estimates on revenue and earnings. So yes, report that, please. They withdrew their full year guidance. Yes, absolutely. He's kind of, I'm not saying they're not important. Obviously, they do worldwide shipping, but I think he's interpreting his own numbers of exactly what's going on in every business around the world, and it's not it's not a good comparison, in my opinion. Now, if you believe it, then holy crap, the world is ending, right? It's probably time to go to cash and check back in 5 years, if you're listening to what this guy says. But I just don't think his one opinion and the others that you've been seeing catching a lot of airtime, the bear market regulars, the world is ending, right? So if you think the world's ending, as much as it pains, my job is to keep you invested and tell you to hold the line and hold through it. If you're at your pain point, you have to go to cash, and there's nothing I can do to help you at that point, other than we can go into CDs. This has been a no place to hide. So even the CDs we've gone into have dropped a little bit, less than $1 from their $100 par. But if you start talking big numbers, that's big money. But you can get up to CDs. We're up to 4.15% tonight. If you want to move, or tonight, this morning, if you want to move to CDs, that's fine. Just realize they're getting a slight hit too. They're just moving down a little bit. We can talk about that another day. But yeah, so the chief exec here talked about how he's seeing numbers and shipping drop around the world, and he's parlaying that to the entire economy. I don't know. I don't think it's as gloom and doom. If I will say, if he's right, then yeah, we're in for several years of recession. But some reasons he's not right. Well, look at the employment level. The government won't admit we're in a recession because employment, I mean, honestly, it's still the best recession ever. I know I say that with some satire, but or some sarcasm, but it doesn't feel like a recession other than people that have CNBC on. Now the stock market's acting like it's in a recession, but in the real world, when you try to go to dinner and there's just not enough staff to help, to seat everybody, and you can't find work, those are not recession type situations. They're just not. Obviously we're at a crossroads with what the market thinks is going to happen. I think the market is pricing in pretty much the end of the world. So every negative data point gets priced in fairly quickly. I do think people are, selling across the board. That's what caused, there's no place to hide. There's nobody buying anything. Even if you talk regular safe havens like gold down, if you would call Bitcoin a safe haven, I know that's an argument. Some people do buy that argument. It's down. Everything is down because everything is being sold. Okay. So inflation is a problem. The raising rates from the Fed is supposedly the cure, and it appears that the cure is going to be worse than the disease at this point. So long term, I think we overreact with raising rates, higher than we ever should have. We're late, and now we have to raise more aggressively to throw ourselves into recession, and then we'll just literally drop the rates right back to zero, is what I think, because there's nobody that wants to stabilize the rates at around 3 or 4% coming back down the other way. It just does not happen. It always goes back to zero. So let's talk about the rates real quick. We do have one coming up, rate hike. It's next week. That's another thing, is a lot of people just don't want to buy in front of the rate hike. So not only are there massive sellers out there, there's just not a lot of buyers that can't wait a week, right? So, or wait for three trading days. So next Wednesday at 2 p.m. Eastern, 1 o'clock here in the Texas area, we're going to have the next rate hike. It's probably going to be 75 basis points. Could be 50. I think the market would celebrate that, or actually might even sell off because they'd be so confused. But, in a full basis point, or 100 basis points, which is 0.1%, if that happened, well, that would be, I think I misspoke there. Anyhow, if they raise by 100 basis points, then obviously that could again continue the selling. So I think 75 basis points it is, and then we'll watch where that takes interest rates from there. The real effect I think that's having that is not necessarily recessionary, but I do think it's going to pull the housing market in, continue to pull the housing market in. 30-year mortgages are up over 6% now. You tack on another 75 basis points, and they're probably over 6.5%. We haven't seen that in a long time. So if you're looking to buy a house, I would avoid that at any, I would wait for the damage to be done. A lot of folks are calling about a 20% sell-off in housing. I think that's about right. So just wait and see, if you will, if you have that opportunity. So that's what we have going on. Overall, are we near where we were to conclude for today for the lows for the year? No. this wouldn't seem so terrible, except we popped all the way up here and then sold back off. We do have CEOs talking about the worldwide recessions. Obviously, that's going to get everybody's attention because these folks are held in high esteem. But that doesn't mean necessarily they're parlaying their little data set to the rest of the world, right? And then, of course, we have the Fed meeting next week to see what's actually going to go on with interest rates, again, expecting that 75 basis points. So that's all I have for you today. Please continue to submit your questions through comments or social media or directly to our email at VIPservices@ankerstarwealth.com. That's all we have for today's show, and we will see you back.